Welcome back to the Deep Dive. This week, wow, we are really getting into it, where Wall Street meets crypto infrastructure.
Yeah, that whole intersection point, it's moving so quickly now.
It really is. And it just makes you think, you know, what really validates crypto for the big traditional finance players?
Mm.
Is it just like the price going up, or is it something deeper?
Well, I'd argue it's definitely something deeper. It's the infrastructure. That's the bedrock, isn't it?
Okay.
I mean, you can't expect these massive funds, pension funds, endowments, to just throw trillions at something without, heavy-duty vetting, audits, regulation, the whole nine yards.
Like they need that security blanket.
Exactly. And that's precisely why this news we're digging into today, the BitGo IPO filing.
It's not just big for BitGo. It feels pretty monumental for the whole digital asset space.
Absolutely. So our mission today is to really unpack the source material around this filing and specifically get into that headline number they're throwing around.
Yeah.
$90 billion in assets under custody, AUC. Yeah, that number. It's not just impressive. It's almost a statement, isn't it? Like a declaration for the crypto infrastructure world.
Right. So what we want to do is break down what this signals, for institutional confidence.
Uh-huh. The kind of capital that, doesn't just chase hype, but actually shapes the market.
Yeah, and what it means for the future of custody itself, and then sort of the ripple effects, right? How does this change crypto for everyone?
Exactly. Moving beyond just the headline to see what's really going on underneath. Financially, technically.
Okay. Now, before we jump right into the filing details, there's something we wanted to touch on quickly. It's kind of a preliminary point, but it actually connects to this whole theme of visibility and, credibility.
Ah, right.
Think of what BitGo is trying to achieve with this IPO. They want transparency. They want credibility in the eyes of Wall Street, right?
Uh-huh. Definitely.
Well, for us, doing this kind of deep dive content engagement from you, the listener, it works in a, kind of a similar way.
Yeah, that's a good point. Your engagement, subscribing, commenting, just letting us know you find this useful. It's like a signal.
It really is.
Just like BitGo's transparency signals trust to institutions, your support helps make specialized content like this more visible. It tells the algorithms, hey, this is valuable.
And that visibility helps us keep doing this, keep digging deep into these complex crypto topics.
So yeah, we really appreciate when you engage. It genuinely makes a difference for creators trying to provide quality analysis. It lets us keep the lights on, so to speak, and keep exploring this stuff.
It does indeed. A well-supported platform can really tackle the tricky subjects.
Yep.
Okay, but speaking of massive support, let's talk $90 billion. All right, let's unpack this. So the core event. BitGo has officially filed the paperwork. They're going for a US IPO.
Yep, the S1 is out there, or the process has begun at least.
But the number that just jumps off the page, the anchor, is that $90 billion in assets under custody.
Mm-hmm.
What does that number actually mean right now in this market?
Well, it's seismic, really. $90 billion isn't just pocket change. It represents a massive amount of institutional trust.
Okay.
We're talking assets from, sophisticated players, hedge funds, big corporations, maybe wealth funds, and definitely the crypto arms of some TradFi giants.
These aren't retail folks just parking some coins.
Exactly. These clients, they demand top-tier, almost military-grade security. They need robust insurance, and critically, they need absolute clarity on the regulations, how their assets are held.
So that $90 billion figure, it's basically a validation stamp for BitGo's tech and legal setup.
Precisely. It says, okay, these guys can handle serious money securely and within the expected compliance frameworks.
Do we know what makes up that $90 billion? Is it all Bitcoin and Ether, or is there other stuff in there inflating the number, like stablecoins?
Good question. The filings themselves are complex and the mix changes, but yeah, general analysis suggests it's a blend. A big chunk will be the blue chips, right? Bitcoin, Ethereum, those are what the ETFs and big funds are mostly focused on right now.
Makes sense.
But importantly, you're seeing a growing slice of stablecoins, especially for institutional settlement, and also these emerging tokenized assets, RWAs, real-world assets.
Okay.
The fee structure might vary depending on what they're holding, but that scale, $90 billion, it proves they're seen as a trusted vault for a whole range of institutional assets.
Let's talk about the money side for a sec. How does $90 billion AUC turn into revenue for BitGo? And how does the market even start to put a value on this IPO?
Okay, so typically custodians charge based on basis points, BIPs.
Right.
It's a small percentage of the AUC, maybe somewhere between, say, 10 and 30 basis points per year. It depends on the asset, how complex the service is.
Okay, so 0.10% to 0.30%.
Yeah. So even if you take a conservative average, like 15 basis points on $90 billion, you're looking at roughly, what, $135 million in annual recurring revenue, just from basic custody fees.
Wow, okay, not counting other services.
Exactly, not counting trading fees, staking revenue, things like that. Now, for the IPO valuation, investors will look at metrics like SaaS companies use, those revenue multiples.
But crypto's volatile, right?
Right. So a traditional tech firm might get a 10x or 20x multiple on revenue. A crypto custodian probably gets a discount because the underlying assets bounce around so much.
Okay.
But having that huge $90 billion AUC, that proves they have significant defensible market share. And that commands a premium. It shows stickiness.
And the timing of this filing,
Hmm.
it feels really significant, doesn't it? This isn't happening during some crazy bull run peak.
No, it's happening after some of the darkest days in recent crypto history. That context is absolutely key.
Post FTX, post Celsius.
Exactly. Post all those centralized blowups caused by, lack of transparency, funds getting mixed up, terrible controls. So BitGo stepping up now is a deliberate move. They're basically shouting, hey, we survived the chaos, we securely handled $90 billion, and we're ready for the intense scrutiny of being a public U.S. company.
It's like they're trying to actively change the narrative, away from disaster toward stable infrastructure.
That's exactly it. Shifting from centralized failure to, let's say, decentralized potential realized through regulated infrastructure.
So if those collapses created this huge credibility gap, BitGo's IPO is like offering a credibility premium to the market. It's more than just fundraising.
Oh, way more. It's fundamentally driven by what institutions need. They need trust.
And going public forces transparency.
It mandates it. Quarterly reports under GAAP standards, risk disclosures out the wazoo, external audits. Institutions demand that level of verifiable proof.
They can't afford another black box situation.
Absolutely not. They have fiduciary duties. They need to know their counterparty isn't playing games. So that increased visibility plus knowing the SEC is watching, even if that's a risk for BitGo, it provides those essential credibility markers. Without that $90 billion, it probably wouldn't be there.
Okay, so that visibility piece connects directly to why custody is so fundamental. I think maybe some retail folks still think of it as just, holding your keys. But it's way more than that for institutions, right? It's the essential plumbing.
It's absolutely the essential plumbing. It's the gatekeeper. And the reason is rooted in the legal structure of finance, especially fiduciary responsibility.
Okay, explain that a bit more. Fiduciary responsibility.
Think about those huge pools of capital we mentioned: pensions, insurance money, sovereign wealth funds. Often they're legally prevented from just holding volatile assets themselves.
Really? Like by law?
Yeah, under rules like the prudent man rule in some jurisdictions. They can't take on that kind of operational risk without a qualified, regulated, audited third party, the custodian.
So the custodian takes on that specific risk for them.
Exactly. It's a compliance shield. It protects the end client's assets.
So what does that fiduciary duty actually involve for someone like BitGo? What are they legally promising?
Several critical things. Number one, segregation of assets. Absolutely crucial.
Meaning keeping client money separate from their own.
And separate from other clients' money, too. Your $100 million in Bitcoin has to be identifiable and completely walled off, no commingling. That was the core issue with FTX, right? It also means a duty of competence providing the best possible security, that military-grade stuff, and avoiding conflicts of interest. Without proof they're doing all this, TradFi just can't engage.
You mentioned military-grade security. For listeners who are a bit more technical, what does that actually look like? It's not just a complex password, presumably?
Oh, heavens, no. The gold standard now is MPC multi-party computation.
Okay.
This means the private key needed to move assets is essentially broken into shards, mathematically. These shards are held by different systems or even different trusted parties. No single entity ever holds the complete key.
So no single point of failure.
Precisely. It massively reduces risk. On top of MPC, you have intense organizational key management. Think physical security for hardware, secure modules, elaborate procedures, often called key ceremonies.
Key ceremonies. Sounds dramatic.
It kind of is. Multiple trusted people have to be physically present, following strict protocols to authorize large transactions. Plus, assets are nearly always split. Most in deep cold storage, offline and ultra-secure, with a smaller amount in warm storage for operational needs. It's layers upon layers. That's what satisfies the institutional auditors.
Okay, so when a company like BitGo, with that kind of setup, files for a major US IPO, it creates this broader legitimization effect for crypto, right? Does it help validate the whole institutional on-ramp?
It absolutely does. Two main effects, I think. First, just the act of going public signals operational maturity. It's a different kind of validation than just price appreciation.
Okay.
Second, and maybe even more crucial, is the regulatory signal it sends.
How so?
If a major U.S.-based crypto custodian can operate successfully under public scrutiny, following GAAP, meeting SEC requirements, it demonstrates to regulators like the SEC or the OCC that this can be done, this infrastructure can be regulated.
So it might lower the perceived risk for regulators looking at other crypto products.
Potentially, yes. It could make them more comfortable approving new institutional things down the line, maybe certain derivatives, more complex ETFs, things like that. It builds a track record of compliance within the system.
And we have a perfect real-world example of this dependency. The BlackRock Bitcoin ETF.
Right.
The source material highlights how much they relied on custodians.
Textbook case. When BlackRock or any of the spot Bitcoin ETF issuers went for approval, they had to meet really strict requirements, especially under the Investment Company Act of 1940 about protecting shareholder assets.
Right.
Their solution. Appoint an independent, regulated custodian. Coinbase custody was a major one they used to physically hold the Bitcoin backing the ETF shares.
So the ETF share is just a wrapper, basically.
Exactly. You buy the ETF share, a traditional security. Its value tracks Bitcoin because the issuer has that Bitcoin held safely by a regulated third party like BitGo or Coinbase custody. Without that custodian acting as the trust layer, meeting those segregation and security rules, BlackRock couldn't launch the product. Billions couldn't flow in.
Okay, so if BitGo pulls off this IPO successfully, gets a decent valuation, that must kickstart things for competitors, right?
Yeah.
What about the custody IPO pipeline?
Oh, it absolutely greases the wheels. Success here provides a public, vetted template for others. It builds confidence all around with other potential issuers, investors, even regulators. So yeah, a successful BitGo IPO could definitely encourage other big custody players to think about going public too.
Like who else is in that tier?
Well, you've got specialized firms like Fireblocks, maybe Anchorage Digital. Anchorage is interesting because they already have that federal trust charter from the OCC.
So they're already partly integrated into the traditional banking regulatory world.
Exactly. It shows there's already a path for these crypto-native specialists to get that formal regulatory blessing. And honestly, the demand for trusted, audited custody, it probably still outstrips the current supply. So yeah, expect more moves. It's becoming an arms race for that institutional market share.
Let's bring this back to the individual listener, maybe someone who's just a retail investor, holds some crypto. How does all this institutional plumbing, BitGo filing an S1, how does that actually affect them? They're probably not using BitGo directly.
It affects them indirectly, but in really important ways, mainly through reducing systemic risk and building overall trust in the asset class.
Okay. Well,
think about it. When the big players demand higher standards, transparency, security, no commingling of funds, those standards tend to lift the entire industry. The bad practices that led to the 2022 collapses become less tolerated everywhere.
So better practices at the top trickle down.
Exactly. If you, as a retail user, are holding your assets on an exchange or through a platform that uses one of these top-tier regulated custodians behind the scenes, your assets are fundamentally safer.
Because the underlying infrastructure is more robust.
Precisely. It's like strengthening the foundations of the entire building. Everyone benefits from that stability, even if you're not directly interacting with the company laying the new concrete.
Okay, that makes sense. What about for more active traders? Liquidity is key for them. How does a more regulated custody backbone, signaled by this IPO, help with market liquidity?
It helps massively by reducing counterparty risk. That's the big fear for institutions.
Fear of the other side blowing up.
Yeah, exactly. When institutions know their assets are held securely by a regulated custodian and their trading counterparty is also likely using similar robust infrastructure, they feel much safer deploying large amounts of capital.
Trade more freely.
More confidently, yes. They can provide more liquidity for market making, engage in more complex strategies. That confidence leads to deeper order books, tighter spreads between buying and selling prices, less slippage on large trades. It just makes the market healthier and more efficient for everyone.
And it probably helps flows into things like ETFs, too.
Directly. The safer and more reliable the custody, the more appealing those ETF products become for pumping serious capital into crypto. More ETF inflows mean more underlying crypto buying, boosting overall market activity and depth.
So, setting aside the day-to-day stock price of BitGo once it lists, this IPO itself feels like a powerful validation for the long-term believers, right? the crypto is here to stay thesis.
Absolutely. That validation is maybe the biggest intangible benefit for long-term investors.
Why specifically?
Because when major infrastructure providers handling tens of billions in institutional money go public on a major U.S. exchange, it cements crypto as a permanent fixture in the financial landscape. It's
Right.
not just a speculative fad anymore.
It shows commitment beyond just price speculation.
Precisely. It shows serious capital, time, and compliance resources are being dedicated to the underlying tech and infrastructure. That signals long-term institutional belief, which is very different from just chasing a short-term rally. It's a sign of maturation.
Now, to really understand BitGo's position, the source material suggests comparing their market share. If BitGo has $90 billion AUC, how does that stack up against, say, their biggest rival, Coinbase custody?
Yeah, that comparison is crucial. Coinbase custody's numbers tend to be higher, often fluctuating,
Yeah.
but maybe in the $150 billion to $200 billion range, sometimes more.
Wow, significantly larger.
They had a big first-mover advantage, plus deep integration with many U.S. institutions, and notably many of the big ETF issuers.
So BitGo at $90 billion is like a strong number 2.
Exactly. A very credible competitor, perhaps with a slightly different client focus in some areas. Seeing that gap tells us it's a competitive market, which is generally good. But we also need to watch the flows.
What do you mean by flows?
How much of the new money, especially from things like the ETFs quarter over quarter, is going to which custodian? That tells you who the newest institutional capital trusts most right now. That flow data is really revealing.
And looking ahead, what about the growth projections for this whole custody sector? $90 billion is big now, but what's the potential?
Huge potential. Most analysts see the crypto custody market growing exponentially. We're talking projections heading towards maybe $500 billion, maybe even more, by 2030 or so.
$500 billion. What drives that?
Well, potentially more ETFs, right? Ethereum ETFs, maybe others. Continued tokenization of real-world assets, that's a massive potential market. And eventually, you'd expect sovereign wealth funds to start allocating more seriously.
So BitGo's $90 billion, while impressive now, positions them for a much bigger future pie.
Absolutely. It confirms we're likely still in the very early stages of real institutional adoption. The custody battle is really just getting started.
Now, when we talk custody, we often think Bitcoin, Ethereum, simple storage. But you mentioned earlier, these custodians are becoming gatekeepers for the whole Web3 world.
Yeah.
How does their job expand beyond just holding keys?
Yeah, we really have to broaden that definition. They're becoming the essential compliance and security bridge between traditional finance and all this complex Web3 innovation.
Okay.
So their role now includes things like holding tokenized assets securely, managing the complex legal strings attached to real-world assets, RWAs, when they're brought on-chain.
Like tokenized real estate or bonds.
Exactly. And securing the reserves backing stablecoins for institutional issuers, they're building that layer of trust and compliance needed for institutions to even think about touching things like DeFi. It's way more complex than just basic crypto storage.
Let's drill down on RWAs for a second.
Right.
That's a huge buzzword. What's the specific challenge for a custodian like BitGo when they're handling, say, tokenized real estate that they don't have with just Bitcoin?
The complexity jumps way up because it's often hybrid custody.
Hybrid.
Yeah. With Bitcoin, the private key is the asset, essentially. With an RWA, the custodian needs to secure two things at once: the digital token on the blockchain and the underlying legal claim or title to the physical asset that token represents.
Ah, connecting the digital token to the real-world legal paperwork.
Precisely. They have to ensure that whoever holds the token legally owns the thing, and that this is tracked perfectly between the blockchain and traditional legal systems. It means blending old-school trust services and legal frameworks with cutting-edge crypto security. RWA custody is probably one of the most challenging areas, legally and technically.
Okay, so given BitGo's IPO filing and this potential validation, what specific Web3 areas might see faster institutional interest now?
Staking products are definitely high on the list.
Staking ETH, for example.
Yeah, institutional demand for Ethereum staking is significant. It offers yield on a major asset. But staking has risks, right? Slashing risk getting penalized if your validator messes up.
Right. Institutions hate unpredictable risk.
Exactly. So they need custodians who can manage the validator keys securely, maybe offer protection against slashing, and ensure they can get their staked assets back easily. BitGo, proving its robustness, helps validate custody for staked assets generally.
What else besides staking?
The source material also points to growing interest in custody for other blockchains, specifically mentioning Solana. That shows institutions aren't just looking at Bitcoin and Ethereum anymore. They need secure storage across different layer 1s and layer 2s as they explore wider opportunities.
And what about DeFi? It's often seen as the Wild West, too risky for big institutions. Can custodians like BitGo actually bridge that gap?
They're really the only ones who realistically can bridge that gap right now.
Why?
Because institutions can't just connect a corporate wallet to some anonymous DeFi protocol. The compliance risks are enormous.
Okay.
They need an intermediary, a trusted layer that handles KYCML, manages counterparty risk, ensures regulatory boxes are ticked. Custodians can provide that, maybe through curated permission DeFi pools or structured products that interact with DeFi safely.
So the custodian acts like a regulated gateway to DeFi.
Exactly. A public audited custodian like BitGo makes those institutional-grade DeFi integrations. Maybe secure lending, yield farming, embedded pools seem much less scary for a large corporate treasury or fund manager. They turn the anonymous risk into a known, regulated relationship.
Okay, finally in this section, what about the big banks, the personal players? If BitGo does well after this IPO, does that force their hand?
It absolutely cranks up the pressure. It creates maybe not panic, but definitely a strong sense of urgency for the incumbents who've been slow to move.
They've been mostly dipping their toes in pilot programs.
Yeah, lots of exploration, pilot projects. But if BitGo lists successfully, shows strong client growth, gets a solid valuation, it forces a decision. Build, buy, or partner. And quickly.
So we might see banks accelerate their own crypto custody plans.
I'd expect so. Either through heavy internal investment, maybe acquiring smaller crypto tech firms or striking more formal partnerships. We saw this trend starting years ago, actually.
Like who?
Fidelity Digital Assets is a prime example. They set up their custody arm quite early, well before the spot ETFs got approved.
They saw the writing on the wall.
They did. They signaled that eventually, providing these services would be table stakes for major financial institutions. BitGo's IPO just underlines that inevitability and likely speeds up the timeline for everyone else.
All right, no deep dive is complete without looking at the other side of the coin. The risks, the challenges. Going public brings credibility, yes, but it also puts BitGo squarely under the regulatory microscope, doesn't it?
That's the #1 risk, absolutely unavoidable. Choosing to be a public U.S. company means the SEC is going to be looking very closely, probably more closely than ever before.
What does that mean in practical terms? More paperwork?
More paperwork, yes, but also significantly higher compliance costs. More lawyers, bigger compliance teams, and much greater exposure if regulations change or if the SEC decides to interpret existing rules differently.
Like how they classify certain tokens.
Exactly. Imagine the headache if the SEC suddenly declares a bunch of assets that BitGo custodies are unregistered securities.
Yeah.
That creates huge operational and legal hurdles. This intense scrutiny. It's simply the price you pay for that institutional credibility stamp.
And regulation isn't the only storm cloud. This custody space is getting crowded, right? It's super competitive.
Brutally competitive. And it's fragmenting. BitGo is fighting on multiple fronts.
Who are the main rivals we need to think about?
Well, you've got first the big exchange-linked custodians like Coinbase Custody. They have a built-in client funnel from the exchange. Second, specialized tech firms like Fireblocks, who often focus on sophisticated tech, maybe more geared towards clients who want more control, closer to self-custody but with institutional tooling.
Right.
Third, the giant TradFi players moving in, like Fidelity Digital Assets. They bring decades of trust and, frankly, massive capital reserves.
Hard to compete with that legacy.
Very. And fourth, you've got the internal custody solutions being built by global banks, like JP Morgan and others. So, yeah, it's not a market where one player is likely to just run away with it. Margins could get squeezed. Constant innovation is a must.
There's also a fundamental risk tied to their business model, isn't there? Unlike a typical software company, BitGo's revenue is tied to the value of the crypto they hold.
That link is probably the biggest pressure point for their public stock price.
Because their fees are based on AUC.
Exactly. We talked about those basis points. If the crypto market tanks, say Bitcoin drops 50 or 60% in a bear market, BitGo's assets under custody, measured in dollars, plummets, even if they haven't lost a single client or coin.
And that directly hits their reported revenue.
Directly. Which, in turn, puts huge pressure on their stock valuation. They're much more exposed to market cycles than, say, a traditional SaaS company with steady subscription income.
So they're riskier from an investor perspective.
Fundamentally, yes. Compared to many other tech IPOs, they'll need to really convince investors they have ways to manage that volatility or diversify their revenue streams beyond just AUC fees.
This volatility makes the comparison to the Coinbase IPO back in 2021 really relevant, doesn't it?
Absolutely essential comparison. Coinbase going public was huge, massive mainstream attention, set the first real benchmark.
But the stock performance afterwards was choppy.
Extremely volatile, big run-up, then significant drops, largely tracking those crypto market cycles we just discussed. Now, a key difference is Coinbase relies heavily on retail trading fees, which are super volatile.
Whereas BitGo is more about the custody-based fee.
Right. BitGo's revenue from AUC fees should, in theory, be a bit more stable than trading fees, but it's still directly linked to asset prices. So, investors looking at BitGo will be asking, can they show more resilience than Coinbase did?
Can they prove the institutional custody business is more mature, less tied to retail sentiment?
Exactly. Or will their stock also just become a proxy for betting on the overall crypto market direction? That's the big question the Coinbase comparison raises.
So it's a high-wire act for BitGo. Use the IPO to get that crucial institutional trust, while knowing they're also signing up for intense regulatory heat and exposing a business model that's tied to volatile asset prices.
It's a classic strategic gamble. They're betting that the demand from institutions for regulated, transparent custody is so strong and growing so fast that it outweighs those risks.
The risk of market cycles and the cost of heavy compliance.
Right. Whether the public market rewards them for providing that essential compliant infrastructure or punishes them for the inherent volatility, well, that's what we're going to find out. Their success or lack thereof will tell us a lot about how Wall Street truly views mature crypto infrastructure. #tag outro.
Wow. Okay, this has been incredibly insightful. A real deep dive into the mechanics and implications here. So just to synthesize everything, BitGo's $90 billion IPO filing isn't just about one company. It feels like a major marker for the whole crypto market's maturation. Right.
Absolutely. It encapsulates the shift we've been seeing away from the sort of Wild West early days towards an environment where institutional credibility, operational rigor, transparency, regulation, those are the things that matter most now.
It validates that crypto is sticking around as an asset class.
And critically, it shows institutional capital is genuinely ready to engage if the infrastructure meets their very demanding standards.
Which brings us to that big picture takeaway. Custody. Maybe the most boring part of crypto, but potentially the most critical sector for unlocking that next wave of institutional money.
It really could be. It's often overlooked, maybe underrated, but it's the foundational layer. It's not the sexy yield or the fast trade that brings in the trillions long term. It's the audit trail, the security, the compliance.
The stuff that lets institutions sleep at night.
Exactly. It's the infrastructure that enables the capital flow.
Okay, so as we wrap up, we want to leave you, the listener, with a few things to chew on. Building on everything we discussed, some bigger picture questions.
Yeah, first off, will a successful BitGo IPO actually create a kind of regulated FOMO, fear of missing out?
Meaning, will it force those institutions still sitting on the sidelines, the cautious banks, the endowments just watching, to finally jump in and accelerate their own crypto plans?
Good question. Second, how does the rise of these super secure, regulated, audited, institutional custodians change things for you? If you hold significant crypto, does knowing there's an option like BitGo, bound by fiduciary duty, segregated accounts, make you rethink pure self-custody? Or is the not your keys, not your coins mantra still absolute for you?
That's a fascinating personal calculation. And finally, putting it all together, the $90 billion number, the growth forecast, its essential role. Is crypto custody actually the most underrated part of the entire market right now?
Is it the sector with the biggest potential upside? Precisely because it's the key to unlocking massive institutional flows.
Lots to think about there. How this plumbing, this infrastructure really shapes the future.
We hope this deep dive gave you some valuable context.
Thanks for joining us. We'll catch you on the next one.